Happy Friday. The sun is shining in Northern California. Hope it is wherever you are. And your federal government has been shut down for over 2 weeks, and we're going to talk about it. My name is Dano. Weir. I'm the marketing director for Sonoma Wealth Advisors, Fermata family of brands. We're joined shortly by our managing principals, Daren Blonski, CFP, Chris Sipes, CFP, talking about that very government shutdown. We're going to do what's called a vibe check. If you don't, that's like a cool... I'm trying to be cool and use a cool word. What is actually happening with the various asset classes as a result of the government now being shut down for over 2 weeks, and why it might not be as bad as the media might make it seem. Why are we even looking at other asset classes when seemingly everyone in the United States owns U.S. stocks more than ever? We'll look at concentration and how often has the S&P actually stayed at record highs like we're near now. Let's get the show started.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the markets starts now.
Let's get the guys in here. Chris, you've got 11 kids. You probably not that many.
Give or take.
You know I love to work in words we have no business using. Do they ever hit you with a vibe check? You ever hear this one?
Yes. They hit me with that one. The latest one, Dan, which I was going to ask you what this means. They're always saying 6-7, which I hope that is not. I hope that's not something bad.
6-7 is like the perfect way to sum up this weekend in the market. And I apologize to any of our listeners out there who are actually teachers, because the amount of teachers have to hear 6-7, 6-7, 6-7 from all these third, fourth, and fifth graders like my son is ridiculous. But that kind of the market 6-7, man, 6-7.
Man,
I really hope it's not something awful. And if it is, I truly apologize. I have no idea what it means. My kids say it all the time with a smirk on their face, like Dad doesn't even know.
It's you'll be happy to know that I've done extensive research on 6-7, and I know that I'm over 40 now because I still don't understand it. But basically, it's a reference to a song that talks about a basketball player named Lonzo Ball whose height is 6'7", and the way that it's said in the song is like funny, and so people just started saying it. It's a carp in the system now. People are just saying it because other people say it. So that's the best I can understand it. So it's not necessarily something inappropriate, but it is annoying. And now I'm mad because we should have called the episode that. But we're doing a vibe check, guys. That's what we're doing today. Okay, we're doing a vibe check.
So here's the deal. Like I was asking my 4-year-old, my 10-year-old, what does 6-7 even mean? And if you ask 10 different 10-year-olds what 6-7 even means, you'll get 10 different answers. Kind of when you ask a financial advisor what a value stock is versus a growth stock.
Man.
You get lots of different answers.
There you go.
Epic fail. This is a content miss. We're canceling the broadcast. We got to do a new broadcast.
Start over.
All right. We are here, your hosts today. We are Sonoma Wealth Advisors, the Fermata family of brands. Daren Blonski, Chris Sipes, Dano Weir, $900 million across the various firms under management. And Chris, we are talking first about gold.
Yeah, speaking of vibe check, it seems like every time you look at the prices in the market, take away today, right? But otherwise, gold just seems to get going up every day, and definitely starting to get more interest in it from clients, prospects, just people in general talking about it. Dan, I think you visited a coin dealer recently and mentioned that was quite the experience. So
yeah, do I have a minute to talk about that, Daren? What do you think? Can I drop that?
I'd say run it, man.
Okay, so this is not a paid endorsement. This is a friend of the firm, a friend of ours, who it will be a future guest on our other podcast, It's All Money. His name's Jason Bowman. He owns Napa Gold and Silver over in Napa. And after he'd been on the podcast, I said, hey, man, I got some old coins. Do you do old coins? He said, yeah, come on into the shop. So I bring him into the shop, and these are coins that I inherited from my grandpa. And it's like, they're the silver dimes and quarters that, I was told, never sell these. These are, don't spend these. These are real silver. And I never really understood what that meant as a kid. But a lot of people don't know, if you look at the side of a quarter, you're going to see a little bit of like silver color. It's not actually silver, but then it's a bunch of other garbage metals in there. So our coins aren't actually made of the actual metal. The valuable metal. So I go into the shop, and I have no experience at all going into shops like this or what to expect. And the action in there, guys, people were just coming in. I saw a guy come in with a bag of utensils. He was selling his silver utensils because the silver price has also been all over the place and up. And so the amount of people, the number of people, the variety of people who are coming in who are suddenly interested in gold, it was just fascinating. And Jason was really great. And so, yeah, it was a unique experience for sure.
Pretty cool to hold that much gold in your hand. Did you get to hold some of those gold coins?
He gave me, so I got to talking to him about currency and value and all that type of stuff, and that kind of extends beyond market talk per se, like you might hear from a usual financial advisor, but we really look at holistic approach to things. He handed me this coin, guys, that was minted by Mexico in like the 20s, and it was 50 pesos when they minted it, and it was solid gold. That particular peso is no longer in circulation, so they like de-decimalized their peso or something like that and changed the way that they were printing money. So not only is it worth 0 pesos now, but the gold that I had in my hand from just the coin was worth $5,000, and this was like about the size of a silver dollar. So, to see that in action in real time and have it in your hand. And I'd also brought in some foreign currency that I had no clue what it was. It was just like, stuff people had gotten from trips. And he took a stack of it and he like just threw it to the side. He's like, yeah, that's all worthless. That's not circulating anymore. And then I ended up selling some of the silver coins, and he gave me American dollars, as part of the exchange. And I sat there and I looked at the American dollars and I looked at the worthless foreign currency, and I thought, wow, those are really close to each other. Like, this paper's worth something and this paper's not. So yeah. It was a fascinating experience. So thanks for a minute to share that.
Well, that's similar to the experience I had when he came in to film our podcast in the office, and I had brought this like Spanish, I don't forget what you call it, but very old coin. Looked very old. I'm like, what is this thing, man? I found this in my mom's old coins, and she, said, I don't want it. You can have it. And I'm like, I'm going to go figure out what this thing is. And I gave it to him, and he picks it up. I'm like, oh, it's a fake. And I was like, how do you know? He's like, I just know. I've felt enough of these things. I know exactly when these things are fake.
Snap. Boom. Yeah. You just knew.
Well, if you're interested in this topic, and Dan, you and I talked about this, there was a guy on Odd Lots, and I don't have his name right in front of me, the podcast Odd Lots, who was the guy that the character from Uncut Gems was based on. And so he's a jeweler in New York City, and he has a shop, and he deals in jewelry and diamonds and gold. And like, if you're at all interested in this stuff, you have to listen to that episode, because it's really cool to, like you said, hear from a guy who's right there on the ground and, can pick something up and knows immediately if it's real or fake or whatever. And it's kind of neat.
Yeah,
it's kind of like when we look at a portfolio, right? Someone brings in their portfolio
right away,
start shredding it apart, and like, well, this has got this problem because this over allocation, blah 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 blah. And then people just look at us like, you guys are nuts, dude.
That guest, by the way, was, I may say it wrong, but it's Maksud Agajani, I believe is how you would say that name on that episode that you're talking about, Chris. So
okay, yeah, I guess he's been on a couple of times and was one of the most listened to episodes. So why is everybody talking about gold? Well, we hit over $4,000 an ounce, kind of blew right past that price. Looks like we're at about $42.47 as of today on spot gold. And so, of course, there's all kinds of...
I just have to say, whenever you see gold go parabolic, that's not a good sign. That is a parabolic.
Yeah. It makes you a little nervous, right? And This was from Eric Balchunas on X. He showed that since the origination of GLD, the Spider GLD, which is one of the older, it might be the oldest ETF that tracks gold. The origination was in November of 2004. So we've got 21 years of history there. And if you take that history and overlay the S&P 500, total return, so this is with dividends, this is not just price, that gold ETF has outperformed the S&P 500 over the life of that ETF. Now, you could tell it's the parabolic move that we've seen here recently accounts for a lot of that. But nonetheless, that's something I don't think most people would guess that. I know I wouldn't believe it if I didn't see it.
Daren, what can we? So we're doing a vibe check on the government shutdown, and we're talking about the different asset classes. We can never really know until sometimes years later. But with everything that's happening, can you posit any kind of theory on this spike in gold the last couple of months?
Well, I think you go back to our special guest we had. Was it Mike
Philbrick?
Yeah, and where we talked about, when the U.S. A few years back and the Biden administration decided to start confiscating the Russian gold to pay for the Ukrainian war. You basically told every major bank in the world, if you don't play our games, we're going to take your dollars. Or I guess you should say when the U.S. was going to confiscate the Russian dollars to pay to Ukraine to buy bombs to fire back at Russia. Like it, hate it, agree with it, disagree with it. The bottom line is any rational actor after that point goes, wait a sec, if we don't play the game that the U.S. wants us to play, they're going to take our dollars too. So what you're seeing is a lot of banks, central banking, a lot of countries accumulating gold. And that certainly seems to be part of the price push.
What's also interesting, Dan, on that point is that, if you go back a few years on some of the episodes, we had talked about, to your point about the currency and the paper, right? And how much is that paper worth, and how a few years ago, gold was going up dramatically in other currencies. And so gold had shown this performance, but it wasn't really noticed in the U.S. because the U.S. dollar was strong and was getting stronger. However, the dollar has lost around 10% of its value relative to other currencies this year, and so that has added even more of a tailwind to the performance of gold. Because if you're pricing something in a unit of measure that is getting less valuable, right? It takes more of that paper to buy that same amount of gold. So it's gold being maybe the oldest asset in the world. Maybe, I don't know if real estate is older, probably older, but gold's right there, right? And it's always been looked at as a currency, a medium of exchange for millennia. And so judging where it is relative to your currency is really difficult and a big part of valuing gold.
And I'll just say one more story before we move on to the next topics, because this is not the gold hour. But after I came home from the gold shop, I had a bunch of things that he didn't end up buying, and one of which was just a little fleck of gold I've had since I was a kid that you got like on the Gold Country field trip or something like that. And so I showed it to my son, and I've just never had occasion to show it to my son Harvey. And he goes, "What's that?" I said, "Oh, that's real gold." And he goes, "It is?" And I said, "Yeah." You see his eyes just light up. And he goes, "Well, can I hold it?" And I go, "Yeah." And I take it out. And I go, "Be very careful with it." And to watch someone, to just the visceral reaction of him, who knows nothing of it other than people maybe have told him it's valuable, but seeing him touch and look at it, I could see in real time, like there's a thing, I don't know why, but there's a thing with human beings and this metal, and it's like very primordial, and so it was interesting.
Yeah, absolutely. Taking a hard left turn here, there's not really a way to segue to this slide. This was from Liz Ann Saunders. The average age of U.S. passenger cars on the road at 14.5 in 2025. So the average car age. Now I put this in here so you guys would quit nagging me about my old classic cars and my love for vehicles from the early to mid 2000s. I want you guys to know that it's sort of normal. It's sort of normal to be attracted to these things. But in all seriousness, it's I think it's important to know a lot of people are stealthy with their financial success, right? Not you don't always have to be driving the brand new car or wearing the brand new clothes or doing whatever it is to show, hey, I've made it. I think people would be really surprised to know how many people drive old cars, not because they have to, but because they just don't see the value in spending money on something like that or whatever. And it's not all that I guess abnormal to just have a used car. I know when you're driving down the road, you can feel like you're surrounded by brand new cars everywhere. And I always think to myself, I'm like, did somebody just pay $100,000 in cash for that car, or are they paying that off over the next 9 years, or some insane thing? How do they feel when their kid spills their smoothie on the floor of that thing? So anyway, this slide has literally nothing else to do with anything else in the deck today, but just thought we'd include
just to let us know that it's okay to have older cars. I got you, Chris. Thank you. You're forgiven.
All right. So continuing with the vibe check here, we talked last week about how the sentiment indicators were likely to drop given the big pullback.
You're just starting to sound like a bunch of wannabe teenagers with your vibe check.
Yeah. Last Friday we saw the big sell off on the tariff talk, right?
Daren's crashing out.
Mute yourself, Dan.
Okay. He's crashing out.
So we had the big sell off on the tariff threats, and I believe we called it by market open on Monday that things could be totally different, which is exactly what happened. They reversed course on Sunday. Market comes back out doing pretty well, kind of back and forth. So it's kind of surprising to me actually that the market keeps falling for it, or for lack of a better word. Like it's we keep getting these huge pullbacks on announcements that are less than, in my mind, 5% likely to actually go through, right? But anyway, we had a big jump in bearishness last week. These reports come out on Thursday. The CNN Fear and Greed Index dropped down to 24, which is just inside extreme fear. So for those that watch this for contrarian indicators, starts to get a little interesting. It was at 31 fear last week, and Bitcoin all the way down to 22 extreme fear this week versus 64 greed last week. So who knows, maybe that's just Bitcoin doing Bitcoin things and being, volatile as usual. But we're starting to see that sentiment drop into fear or extreme fear. And so contrarian antennas start to go up a bit. Now, why have assets like gold done so well? Other central banks buying, but also it could be investors all over the world saying, rather than holding dollars, rather than holding treasuries, which is a debt obligation in the United States, it's the whole debasement trade, right? Everybody's talking about the debasement trade. That's been very well known and accepted. It's consensus at this point in the market. And this is why. Federal government outlays, and this is from Peter Maluk at Creative Planning, and he says, for the first time ever, time ever. The U.S. is spending more on interest payments, which is 1.16 trillion, than on our national defense at 1.13 trillion. The cost of past debt now exceeds the cost of protecting the nation. The bill for decades of borrowing has come due. And I'm sure, like everything in life, there's more than one reason why gold is up, and this is probably one of those myriad of reasons, is that the profligate spending of the United States government over the decades is finally starting to pile up to the point where it's becoming a concern for professional investors and global investors alike. And so hasn't seemed to affect the stock market yet, but concerning nonetheless. All right. This is from Bridgewater by way of the Idea Farm. Idea Farm is a free service that anybody can sign up to receive. It's like bullet point, investment topics every week on Sunday. It happens to come right about coffee time, so it's a perfect little 5-minute read if you just kind of read the bullet points. But if you want to dive deeper, it's got articles on all different kinds of topics. And this is from Bridgewater, the hedge fund Bridgewater. Coming out of the financial crisis, households held about half of their financial investments in equities. Today, it has risen to about 80%. The only time it's ever approached this level before was the height of the dot-com bubble. For better or for worse, households' financial fates have become more and more tied to the S&P. And so that's on the left-hand side where they show the allocation to equities. And then on the right-hand side, they show the fact that, hey, if you look at an 80-20 portfolio, this always cracks me up when people are like, well, it's okay, I got 20% in bonds or 25% in bonds or 10% in bonds. It's like, look, that's great and all, but that's going to do literally nothing to help you, because the correlation of a portfolio that's 80-20 is 0.99 with U.S. equities. And so that little sliver of bonds really is not going to do much in terms of dampening the portfolio volatility. Now, if you look at the bonds and say, well, that's where I'm going to pull my immediate needs from, and maybe that 20% covers a couple of years worth of living expenses for you. Okay, I can see that as a strategy. Say maybe it takes a couple of years for the market to work itself out, and I can use those bonds in the meantime, so I don't have to sell my equities at an inopportune time. Okay, own it for that strategy. But if you're owning it to dampen the volatility in your equity portfolio, it's not going to do anything. It's going to be a fire hose, or it's going to be a garden hose on a house fire in that situation.
Chris, I'm going to do what I love to do, but the only thing I'm good at, which is ask really stupid questions. But
ask away.
Some what you're talking about here is overconcentration in U.S. stocks, a lot of times U.S. tech stocks. For people who can't conceptualize this, I think a lot of people, the average person even, just thinks of the market. And some people think there's only 500 stocks total. So when you talk about being over allocated in the U.S. stock market, I'm going to ask the question, well, if I wasn't in the U.S. stock market, where else would I even be? What else is there?
Well, there's diversification within asset classes. So say you're a believer in equities over the long run or stocks. And so there's a whole nother world out there available on stocks. So this is from Bank of America, I believe. No, sorry, Goldman Sachs, by way of Mike Zaccardi. And so this shows that out of the global equities on the right-hand side, global equities, this middle pie chart shows if you were to take like the global portfolio, if you were to buy assets based on their global value, how would your money be allocated? Now, this is considered the quote-unquote efficient portfolio. If you follow the efficient market hypothesis, in that the market in general has accurate pricing for assets in the world. So if that's the case, then about half of your portfolio would be in equities. Of that equity breakdown, you can see about 64% of that current value is the U.S. And so the other 56%, or 46%, sorry, would be 36%. Doing math on the fly here. 36% would be in global markets, and that's where you can see the values of the other nations there. So you can diversify within stocks, so diversifying outside of the U.S. You can also diversify in other asset classes. So you've got bonds. Within bonds, you've got U.S. and global bonds. You've got both inflation-protected bonds and what they call nominal bonds. Then you've got the world of commodities, including precious metals and other types of commodities, oil being one of them, famously, and real estate. So there are other asset classes that you can be invested in. However, the average American, if you just take the average American investor, has most of their money in two places. One would be the equity of their home, and two would be the U.S. stock market. And so, for better or for worse, which lately it has been for the better, most people's wealth is tied up in the value of those two assets within the United States. All right. So now, does that mean dump everything and go to cash, or dump everything and go all in on international stocks or bonds or something else? Probably not. Because we've talked about before, and Daren made a great point last week about how, I hear what you're saying about valuations, but you can't time the market that way because, one, people have been saying that for several years now, and two, there's a lot of smart people that say we're not in a bubble, right? And here you can see that side of the argument, which is that if you look at the forward price to earnings ratios of blue chip stocks now, which is the light blue or gray there, versus blue chip stocks back in the .com era, you can see that they're much more appropriately priced when it's relative to those stocks at that time. And the financials of these companies are much, much better now than they were at that time. So that is definitely an argument. So if that side of the argument is correct, and AI does come through, and it comes through just as quickly as the market is pricing it in, then you will have been a fool to have sold everything and moved to cash, right? And so you don't want to make big rash decisions, because the timing of these things can be difficult, to say the least. The other thing is that returns in the S&P have tended to group in cycles. And so you can see here, these are the number of trading days. The S&P 500 has stayed within 3% of the all-time highs. So what you should notice by this chart kind of right away is that it goes in cycles, and that those cycles tend to group with one another. And so being invested at an all-time high isn't necessarily a bad thing. In fact, most of the time it's a good thing to be investing when it's at an all-time high. Now, investment implications we can read here. It says, while data shows that markets have historically remained near record highs for extended periods during strong economic cycles, investors should remember conditions can change and past trends may not repeat. So there's nobody that rings a bell and tells you, hey, conditions are changing. It changes really quickly, and it only makes sense in hindsight, like the gold run this year, like the run in foreign stocks this year. By the time you notice it, it's already happened. And so you got to be positioned for it ahead of time, which is not easy to do. And last chart this week is just showing going along with those cycles, often people refer to the average of the S&P, and what this illustrates is that there's really no such thing. Of course, there is an average. However, most years do not feel average. Most years you are either doing much, much better than that average or much worse. There, you can see that group of only a handful of years have we actually fallen within that 8% average. That light gray is showing when the annual average return falls between 5 and 10%, which is, the quote unquote average. So very rarely does it have kind of a benign year like that. It's usually much better or much worse, which is what's illustrated here in this chart.
I was promised 10%. I heard 10%, Chris. This is 10%, right? S&P 10%. That's the normal, right? It's 10%. So you got my 10% this year, or that's what I was told.
That's right. That's right. And so because of those cycles and the nature of the S&P, like we just saw, usually goes through 15, 16, 17-year cycles. And within those cycles, the good years are really good. And then it comes out of the cycles, and then the bad years are typically really bad. That whole 10% thing only makes sense over a very long period of time, and it kind of skips a lot of the nuance that is important to understand.
Daren, do you dare show us the Bitcoin chart this week? Are you able to stomach that? You able to hang with that?
Able to stomach the Bitcoin chart? I thought weve talked about this before.
Yeah, unaffected. He's unaffected.
I don't even know what you're talking about at this point. I mean, we've talked about this a lot, but if you're into the Bitcoin world, then volatility is just an abstract of the mind. Let's look at the Bitcoin chart. So what do we got going on in the Bitcoin world? Man, it doesn't actually look super good, but we're still 2 hours out from market close. It's almost 3 o'clock here on Pacific Coast time. We'll reset this candle here at 5 o'clock Pacific here in a couple hours. We've got kind of an ugly double top in the form here. There's a top, there's a top, there's a neckline. When it closes below the neckline, that means there's weakness, but usually, unless, of course, some kind of buyer steps in this moment. But the fact that it traded down last week and then continued to print another red candle, I think we're probably to the downside at the moment. There is a fair amount of support in this area. Let's call it 100,000. You can see we took a nosedive down into that zone here earlier today. The close is always really important. The weekly close is more important than the daily close. The monthly close is more important than the weekly close. Let's look at where we're at for the month. We want to see this pick up this month. We lose this spot, come down to 100,000, then I think we'll see some downside and a buying opportunity. That's not advice. That's just usually what happens when markets sell off. Let's look at the number 2 crypto, ETH. Lots of discussion in the media today about ETH with Tom Lee and some of their portfolio managers talking about it. Not a good look, though, the fact that we looks like we're going to close this week below these highs here, and we're flirting with this one. I would want to see this close up above for the week around 4,000. To close below 4 is not to the upside. The risk is to the downside at that point. So probably more volatility coming through on that one. Let's take a look at the S&P 500. That is the largest 500 U.S.-based stocks. You can see this big red candle that basically printed as we recorded last week. We got blown out. You can see it on the daily chart. It was not a bad week and then fell out of bed. On Friday, found support, and we've just kind of stayed inside this week, this candle. Not a particularly strong, not a particularly weak look at things, but not a lot of people willing to step in and say, yeah, let me have some of that risk. Load me up. That is not looking like it's on the cards. But the fact that we're holding above this support level of 652 and change, or 650, I'd say that's fairly positive. So a whole lot of nothing burger this week in the S&P 500. For those who don't know what the S&P 500 is, never heard of it, this is the S&P 500. So you can see it from a visual standpoint. It's called a heat map, and how it did this week. We can take a look and you can see this week it was pretty neutral for our big Microsoft and Nvidias, but a lot of green on the screen other than that. The fact that these are so neutral, though, they're such a big part of the S&P 500. We really want to see those big stocks participate in order to get an updraft in the overall stock market. I always like to look at all the facts that came out from the government this week, and guess what? There isn't much. Why? Because the government is still shut down. So we're not getting a lot of data coming out. The conspiracy side of my brain says, well, that's kind of convenient. We can't see how bad the economy actually is because none of it's actually coming out. But you can see we did get the Philly Fed manufacturing index, which didn't look particularly nice or rosy. Other than that, we don't really have much data coming out from the fundamentals. So we are left for price action and trying to get the market to interpret what's going on. Watching oil closely, U.S. oil, crude oil, WTI, flirting with these lows here that we saw back in early part of the year. We're back in that zone with the peace in the Middle East, looking like it's holding at least for the moment. Seems there might be some calming in the Russian-Ukraine, or at least President Trump meeting with the Ukrainian president today. I did see an interesting tone shift from the Ukrainian president. He came out earlier today and said, hey, we just need to all stop fighting where we're at, whereas it used to be give us all our land back. So that's a little bit of a shift in how he was talking. That could be good for oil, could be good for overall world peace. But with that in mind and the expected slowing down economically, and you've got governments getting along, at least on the surface, not bombing each other, that looks not as good for oil because it doesn't constrict supply. So you would think that would be good for peace in the Middle East, but it isn't really in some ways, because then we can pump more oil out of the ground if everybody's getting along. In addition to that, the military industrial complex, whatever you want to call it, is something that creates a lot of demand for economics, a lot of demand for oil. And if that's slowing down a little bit, well, we're not burning as much oil. That coupled with a slowing economy, which I think is what the data would show if it were coming out. I was just looking at one report that came out of Harvard. Who knows if the data is correct, but everyone's looking at these extraterrestrial data sources now because the government's not giving us their completely joker data. But anyway, the Harvard came out and said that if it hadn't been for the building all these data centers for AI, that basically the economy would be flat. And I think that feels right. Like, I don't feel like in the way you go out there in the economy and things are moving along, but you don't have this sense of things just bustling crazily. But you certainly get that when you talk to people who are in the AI world and the technology related to AI and the electricity related to AI. You feel that. And I think that anecdotally feels correct. When we look at NVIDIA, why NVIDIA? Why do we care so much? Because they're such a big part of the S&P. That's why we care so much. And you can see that it had kind of a red week overall. And we're sort of just trading sideways. We broke out here above 183. Couldn't really hold it, and now we've come back in, and it looks like we got rejected right underneath that 183, which was an all-time high back here, which was resistance. We broke above, didn't happen for it. And the fact that it closed below resistance again, I'm leaning towards the downside. Where would I see it going? I could see some support right here at that 173 line. I think that's a pretty strong area. So we're kind of bouncing along this area, and then we broke out. Oops, nope, just kidding. Not going to do that right yet. We are going into the end of the year. Markets tend to ramp into the end of the year, although in Trump's first term, the market did not ramp in the end of the year. So we'll see how it plays. Chris talked about gold. I don't think it's
Oh
a
my
particularly
God.
good thing that gold's going up like this. A red week on the screen for gold, and kind of got this shooting star looking type of candlestick. Uh, I just don't think it's a good thing to see gold do this.
No, I agree. Tom McClellan of McClellan Oscillator fame said something to the effect of equity markets top with like a rounding pattern, and gold precious metals tend to top with like a spike pattern. So I don't know if you wrote that like just today, but that's a little concerning.
Yeah, it's usually not a good sign when you have governments like diving and tripping over themselves to get gold.
It seems like it's like the financial equivalent of stockpiling ammo. Like
Yeah.
if I was stockpiling ammo, water, and white bread, would I really be in a really positive state of mind? Likely not.
Well, especially when you got a dollar that looks like this. This is DXY, which is comparing the dollar to the other major currencies. And when you got the dollar that's updated to see what we're down this year. But the value of the dollar right now compared to other currencies is down over 10%. So, gold going up, value of the dollar going down. That's not the great look we're looking for here for a bustling, robust economy and economic set of circumstances. So it's hard to say, like I don't, this whole move with AI has been so persistent and gone on a heck of a lot longer than I thought it would have. I do remain fairly positive for the outlook for the end of the year. Just because seasonality, even though the seasonality didn't play out in September, it tends to ramp in the end of the year. That's higher probabilities of that anyway. But we're not seeing that strength. We're really going to have to see NVIDIA, Microsoft, Apple just crush it. And they're all kind of trading sort of sideways at the moment.
Also, if you look at the VIX and the spike that we saw on the VIX, it's since calmed down, thankfully. But wow, we got a big ramp up in the VIX. There was a big initial change in the spreads between high yield debt and treasuries. So that is usually a sign of stress in the markets as well, along with gold going up, and they all calmed down like very quickly. So I don't know. There was news this week of the regional banks with the loan, the issues with the loans for a few of the regional banks. And that's on top of news from the auto lenders just a couple of weeks ago, the subprime auto lenders, where they had basically over collateralized the loans, and so there was no collateral there for a lot of the loans, and so those were bad as well. And so we keep getting these like little initial spikes of like, oh, maybe this is like the thing that's been lurking under the surface, and then it seems to quickly disappear. But there's got to be some explanation for the VIX spiking, the gold market, bonds catching a bid, all these like flight to safety type of assets under the surface. But the equity market just keeps going up, so it's a conundrum.
Yeah. So yeah, overall, I don't think it was a very eventful week. Kind of a boring week for the markets, and we're trading sideways at this moment. Keep an eye on NVIDIA, Microsoft, Apple to see if they drive this market higher. They're such big portions of the market that they remain the kings. When we look at interest rates, just to take a look real quick at the 10-year, and you can see the 10-year trading below this long-term trend line, and the fact that it came in here, found resistance. So just so everyone's clear, this green line, this diagonal, that's been drawn in for weeks on my charts. If you go back to our videos, I did not just draw this thing in, and it's magical how it goes and trades up into that and gets rejected. So that's a rejection of that long-term support for the 10-year. I think risk is to the downside on the 10-year, which is good for home buyers. It's good for people that are looking to take out money. It's looking to me like we're going to see some more downdraft in the 10-year, which will help mortgage prices, et cetera, in theory. You never know how it carries through the market completely, but it should help. I think we're going to leave it there for the week. Hope everyone has a wonderful weekend. And like always, we'll be back next week.
So just so we can wrap up our vibe check, I'm going to say that one more time to piss Daren off.
It doesn't piss me off. It just makes you sound silly, Dan. Cringe.
I enjoy being cringe. I think the reason why we wanted to do this and take a look is because there's been so many times this year, aside from the tariff incident in April, but there's been so many times this year where there have been things where it could be the narrative for, a slowdown or a deep dive. And in fact, we've just seen this honey badger resilient market where it's just like, whatever, up and up and up and up and up and up and up. And we're checking in this week and we've got the government shutdown rolling on, and it not necessarily the major downturn this week, but not kind of going sideways. I mean, not a great week either. And kind of a fear asset like gold still seeing a pretty big spike, even though it was down this week. So, it seems like it's like cautiously unoptimistic if I had to put a number on it, Chris.
Yeah, I think that's well said. Equity market continues to chug ahead, but under the surface, there's all these signs of anxiety and paranoia that spike up every now and then, and it feels like the narrative changes for one day, and people get a panic like we saw last Friday. It's like everybody's partying in the theater, and there's like a little door for the exit, right? And everybody's kind of eyeing that exit, and every time something little happens, everybody starts rushing for the door, and they're like, "Oh, it's fine. It's actually fine. We'll stay here."
We will see, as we will always every week. Every week, we're always looking forward to next week. Thank you so much for checking out our show. We are on the markets from Fermata Advisors, our family of brands, Sonoma Wealth, Fermata Tax, Fermata 401k. If you are looking for private wealth services, if you're one of our clients, thank you so much for checking us out. If you are a prospective client or looking to learn more, sonomawealth.com is where you can get started. And wherever you found this show, whether it's YouTube or maybe Apple Podcasts, we're also on Spotify. Subscribe, follow us. That's the best way to make sure you don't miss future episodes. And we really appreciate you listening all the way to the end. We will see you next week here on Fermata on the Markets.
You're up to date with Fermata on the Markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Ellaway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.